David Guttery is an investment advisory representative of Emeritus Investment Corporation and president of Keystone Financial Group in Trussville, Alabama. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, president of Keystone Financial Group here in Trussville, for a discussion about managing volatility when investing for long-term objectives. Hello David, how are you today?
Doing
We're
well.
glad you're with us. We're certainly seeing the return of volatility over the last 18 months. It can be nerve-wracking to see markets move hundreds of points in one day. Can you describe for our viewers what is causing markets to move so dramatically?
Well, to some degree, we do live in a new normal paradigm. It's hard to believe that the first iPhone was introduced on the 29th of June in 2007. The emergence of such technology, however, has facilitated a world where information is instantly available and from any number of sources. As technology has evolved, so too have programs that allow professional money managers to instantly trade large blocks of securities through what we know as high-frequency trading. Algorithms are also employed by institutional managers. An algorithm is merely an if X then Y instruction that will execute when triggered. If a stock price hits X dollars, then the program will immediately sell Y numbers of shares, for example. So being constantly exposed to instant information and watching the red and the green blocks flash by the trade on your Yahoo phone app, coupled with the mechanics of high-frequency trading and algorithmic trading, can really set a stage for short-term worry, angst, and fear as markets gyrate by hundreds of points.
Well, that's true. Developments in technology can have pros and cons when it comes to investing. Some would argue, though, that sometimes the markets don't seem to be moving logically. What are your thoughts on that?
Actually, I believe the markets do the same thing each and every day. It may not seem logical at the time, but markets constantly reprice risk, and I mean on a second-by-second basis. Markets are simply responding to changes in assumptions on a constant basis. Going back to my earlier point about being in a new paradigm, we've never experienced an environment within which a single tweet could move markets by hundreds of points. On the 1st of August, for example, President Trump tweeted about the imposition of a new 10% tariff on $300 billion of new Chinese imports. There was no lead-up, no forewarning, or anticipation of the announcement. Indeed, when the tweet was released, the market was up around 200 points, but by the end of the day, we were down nearly 400 points. One tweet was the catalyst for a 600-point intraday market swing. It came out of the blue, it caught the markets off guard, and immediately the risk of such having an impact on the U.S. economy began to be repriced into valuation assumptions. It's the world within which we live now. And now more than ever, investors should be much more concerned with long-term objectives than short-term outcomes.
Well, that makes sense. So David, how do you help clients navigate through periods of volatility?
For some clients, there are mechanical things that we can do as we anticipate unforeseen volatility. Through the use of put options, for example, we can utilize derivatives to establish a floor under the value of a stock holding. For other clients, it's the discipline that comes with the dilution of shares. For example, if a client has purchased a stock for $100 per share and it declines in value to $70 per share, well, if we remain convicted about the position, then my advice would be to purchase additional shares. If we're right, then the stock returns to $100 in value and the original shares have broken even, while the shares that were purchased at $70 brought a nice gain to the position. And we have a higher holistic value than had we done nothing. Still, for others, it may involve a passive strategy, like quarterly rebalancing or dollar cost averaging. Any mechanical strategy like this must be employed and viewed against the backdrop of economic strength and other market metrics. If overreaction and perception have presented you with a buying opportunity against otherwise strong fundamentals, You must have the intestinal fortitude to take advantage of those opportunities.
So there are mechanical ways for addressing volatility, but David, how do you help clients manage the emotional fallout of market volatility?
As we have discussed in previous videos, we identify the right investment approach through objective-driven planning. When faced with periods of higher volatility, we return to the nexus of our plan and why we took the actions that were taken. Are we still driven by the production of durable income? Or are we still driven by the quest for growth? Sometimes periods of time such as this cause us to change our statement of investment selection. At the end of the day, I am helping to manage the emotional side of volatility by being present and aware and informed and reminding them of the long-term objective that we're pursuing. In our video from June, we talked about if it is to be, it is up to me. Well, if it is to be that you endure and make periods of volatility work for you, then it is up to you. I'm here to help clients in that process.
David, as always, thanks for joining us and thank you for the timely information. David may be reached through the means listed upon the following screen. And for the Trustful Tribune, I'm Brannon Dawkins.
David R. Guttery independently offers securities and investment advisory services through Emeritus Investment Corporation, member FINRA and SIPC. AIC and Keystone Financial Group are not affiliated. Additional products and services may be available through David R. Guttery or Keystone Financial Group that are not offered through AIC. Some of the products and concepts discussed have their own cost and are subject to risk, including the possible loss of principal. These costs and risk will be thoroughly discussed with you prior to any recommendation or solicitation. Past performance is no guarantee of future results. Information provided is gathered from sources believed to be reliable. However, we cannot guarantee their accuracy.